This is Dishin with Gary Pickren, South Carolina's only podcast dedicated to the real estate agent craft. And now, the host of Dishin Gary Pickren.
And greetings, welcome back, everyone, to a very special edition of Dishin I'm your often opinionated but rarely wrong host, Gary Pickren, coming to you from Columbia, South Carolina. The last week of January 2025. And with me today, I have a very special guest. Nick Kremydas, as everybody knows, is the CEO of the South Carolina Realtors Association. He's a good friend of the show, good friend of mine, and he is joining us today from Washington, D.C. to talk to us about the ATI exemption that is quickly coming up. The filing deadline's coming up. So welcome to our show, Nick. Great to have you on Dish and Dirt once again.
No, thank you for having me back, Gary. And I wish it was July because it's about 17 degrees outside. So I am in D.C. for our National Association Advocacy training this week, but I am not actually outside. That's a fake backdrop because it is so cold outside.
Yeah, it's cold here at home as well, but we are certainly happy that you're joining us today. So what's going on in D.C.? What are you up there for?
So our National Association it's called NAR Advocacy Week, where we have gotten updates from our federal advocacy, our lobbying team, all of our various RPAC, the state and local issues mobilization committees, all of the realtors, all of the staff that do work on behalf of our members on the advocacy front are here this week, including our federal political coordinators. Those are realtors that are assigned to individual members of Congress. You know, we have a lot of new members this year. We have one new member in South Carolina, and we're going to be meeting with the Congress people while we're here this week.
And, you know, if you've listened to my podcast this week, talking about the 10 things that I think will be happening and changing in the real estate market this year, one of those things that I mentioned was that I believe that NAR is going to be more important than ever because you got a brand new administration coming in. The realtors have been under attack unfairly for the last year. This gives a chance for everybody to reset what's going on. And Nick being in Washington right now is a prime example of why NAR, SCR, your local associations are so important. But more importantly, what's most important is RPAC, because I can tell you right now, guys, if SCR and NAR were not up there lobbying for you right now, fighting for what you do, nobody would be. So, Nick, thank you for being up there. And I think this is right here a prime example of the value that the Realtors Association provides.
Well, we'll talk about tax reform at another time, but that's certainly on the minds of everyone here. And whether it's increasing the capital gains exclusion for homeowners to help free up some inventory and allow those boomers to downsize and do the things they need to do with their real estate to like-kind exchanges, everything is going to be on the table. And realtors listening know what my favorite saying is: if you're not at the table, you're going to be on the menu. So we have to be here.
That's right.
Again, thanks for letting me talk a little bit about a more pressing deadline that we have here in South Carolina, or there in South Carolina, I should say. A lot of members are familiar with Act 388, the big property tax change that took place in 2006. But a lot of members are not familiar with a subsequent, really the only revision the legislature's ever made, any substantive revision that's been made to Act 308, and that is dealing with assessable transfers of interest. There's an exemption in the law. Under Act 388, y'all know that residential properties got a big tax break, right? The 4% classification. 4%. Well, the burden, very quickly fell on the back of 6% property. Now, that includes retail, commercial, office space, also includes second homes, rental properties, vacation homes. All of those are classified under the 6% rate. So since 2011, SCR, our local associations, we advocated, the legislature supported our position on this by reducing the assessable value at the point of sale. And the way the ATI exemption works, it protects property owners from large increases in property taxes when there's a change in ownership. Now, the property, as many realtors know, the current assessed value could be something that was established 4 years ago, 40 years ago, depending on the last time it was sold. But under Act 388, when a property transfers, and a sale is just one of those triggers. It could be, there are a number of triggers that trigger the ATI. But the new assessed value of that property is determined by the sales price.
Point of sale.
And as we've seen over the last 5 years, property values in South Carolina have generally increased by more than 50%. So your buyer last year, if you represented a buyer that purchased property last year that falls in that 6% category, they have until January 3rd to file for an exemption. Now, this is an exemption. It's a taxable amount up to 25%. This helps keep the property taxes more affordable for the new owner. Now, as I mentioned, the folks who qualify are those that purchased a 6% property last year. And that, again, second home, vacation home, commercial property, any property that's taxed at that 6% rate. If you have had other transfers, in family, LLC transfers, talk with your CPA. That may also qualify for the exemption. But the 25% is simply calculated on the difference between the prior taxable value and the new market value. So, for example, if the property that was purchased was previously assessed at $200,000, the new market value, as determined by the sale price, was $300,000. That difference is $100,000, right? So you're able to exempt 25% of that increase in value. That would reduce that new taxable value down to $275. If I did the math right, I'm not good with math. But the way you apply for the exemption is to go to your county assessor's website, and they have forms. Some counties make it more easy to find than others. But just a reminder to the realtors and licensees listening: you're not a CPA, you're not an attorney. You're not giving your clients financial advice. What you're doing is providing them the information where they can file either with their CPA or through their lawyer or on their own. Frankly, it's very easy. It's a short form, usually 1 page or less, that they can fill out and submit to their county assessor, which will reduce their assessable value, which could reduce their property taxes significantly. So January 31st is the deadline each year to file for previous year sales. So realtors, real estate agents, do yourself I think, number one, I think it's a good way to touch base, as a follow-up with a former client. And also, I think it will leave a very positive impression with those buyers that you worked with last year if they're able to reduce their property tax bill.
And they don't have to refile this every year. They just do it the year when they buy it, and then that reduces it that one time, and then it can only go up then from the 275 in your example. So that's the value they start at, and then every time they reassess, you're always getting that deduction.
Yeah, so either a countywide reassessment would affect that. That happens, supposed to happen once every 5 years, right? Or another point of sale trigger happens where property is transferred and triggers a new assessed values. It's one time, and it stays for the ownership, the current ownership of that property. It runs with their ownership.
I was talking about this with some of the lawyers in my office who, I don't do as many closings as I used to, so they were kind of a little bit more familiar with it. One of the things that one of them stated, I want to make sure I understand this, is that the property currently has to be taxed at 6% when you buy it, or can it already be taxed at 4%? You're buying it and converting it to 6%. Their understanding was it probably had to already be taxed at 6%, and you were buying it at 6% as well.
That's a great question, Gary. My understanding is that it has to have been taxed at 6%, and the new classification will remain 6%. So if you're buying a second home and converting it to your primary residence, it would not qualify for the ATI exemption.
And this is coming up. The deadline is on the 31st, so less than a week away. But this would be a good idea we're currently talking right now in the marketplace about what real estate agents do. And every time I talk to an agent, I keep saying, you don't sell real estate, you navigate. It's the words that the National Association actually used when they did a survey of what consumers were wanting. They want somebody to help navigate through the process. And for me, you're helping navigate that buyer through a process which might save them money. So this would be an excellent opportunity, again, to show your value as a realtor, to go out on social media on your posts and say, this is one of the things that I do as a real estate agent, is help navigate you through the post-closing process, applying for your taxes and telling you, giving you this information, here it is. As Nick said, you're not a tax advisor, so you're not giving tax advice, but you certainly can advise on here are the forms and here's how you can do it and here's what you need to do. So I think that's a great opportunity for our realtors.
And it highlights the value of the Realtor organization, Gary. This is an item that we fought very, very hard for in the legislature. As you can imagine, local governments fought tooth and nail against it. But we saw a need to create some more parity between 4% and 6% properties. Not a total fix to Act 388 by any means, but our advocacy impacts the clients, the customers that our members serve. And when they benefit, the industry, the state benefits. So thank you for giving me an opportunity to talk a little bit about this as we approach the yearly deadline next week.
Yeah, and I can tell you as a real estate commissioner, Austin is always at our meetings. He's always bringing these type of things to us, and we're working together, in my opinion, better than I've ever seen it happen, where the association and the commission are trying to figure out how to protect the public by better equipping the real estate licensees. And I think we're doing a good job. This is another prime example. Hopefully I can talk to you at some point about getting over there and talking about how to shorten this process of going from 6% to 4%. I just moved my house into a trust and they made me redo all of that. And I can tell you what an absolute headache it was. I will give a shout out to Richland County, though. The lady I worked with over there was very nice and helped me through the process, but it is a terrible process. So
the good news is the legislature has tax reform back on their agenda. So we're going to see income taxes will be the kind of the primary thing this session in Columbia, but also personal property taxes. And maybe there's a chance of talking about 6% properties, because they still, even with the ATI exemption, 6% properties are among the highest taxed tax properties in the entire country. So we need to create some parity there.
I've seen tax bills that were $5,000 and $6,000 go to $20,000 and $21,000 in some of the properties we've closed. It is absolutely crazy.
Absolutely.
Well, Nick, again, I cannot thank you enough for your hard work and I'd say this as well. When y'all are fighting for realtors, it does even bleed down to non-members. I think you should be a member of the Realtor Association. 100% believe that. But everything that y'all do has a great effect on everybody in the industry, whether we're lenders, attorneys, appraisers. It affects all of us in a very positive manner. So, Nick, thanks for being in Washington, D.C. today. Thanks for joining us on such short notice to get this message out today. Very kind.
Gary, thank you so much, and look forward to the next update.
I'll have you back on Dishin Dirt soon, I hope.
Take care.